The Honorable Heath Tarbert, Chief Legal Officer and Head of Corporate Affairs for Circle. He was the former 14th Chairman and Chief Executive of the CFTC and the U.S. Assistant Secretary of the Treasury for International Markets. And may I say that my role in writing and presenting the CFIUS Reform Bill that Congressman Barr mentioned today was done with the full support and assistance, and I would say without him I couldn't have done it, Mr. Tarbert. So thank you, sir.
Thank you.
The Honorable Brian Quintez, Head of Policy for the 16th Crypto Andreessen Horowitz, former Commissioner, U.S. Commodity Futures Trading Commission. Mr. G. Kim, Head of Global Policy, Digital Assets, the General Counsel at Crypto Council for Innovation. And Mr. J.C. Boggs, Esquire, partner of the King & Spalding, and my major consultant in everything that I do relative to engaging with you all. He is on our board, and he's the, I'd say he's the chairman emeritus. How's that?
That sounds good. Thank you.
He's great. I could do it without him. So thank each of you gentlemen, and JC, I'm going to turn it over to you to lead this panel. Thank you very much.
Great. Thank you, Congressman. You're on a tight ship, but it's good to be here. I've really enjoyed the day so far. I always learn a lot. I know we just got finished with quantum computing and AI, so we're going to ease into something a little bit simpler. Maybe. But, and by the way, I advise Robert a little bit. He takes my advice sometimes, but it's not on cryptocurrency at all, not investment advice, to make that clear. But thanks again for the quick introduction. I thought before we sort of jump into the substance of things, well, let me ask folks out here, how many people actually have purchased or used cryptocurrency in this room? All right, a fair amount of hands, not too many. So, but I thought we'd just kind of reintroduce ourselves a little bit and kind of what we've been doing and how we came to crypto. And maybe, Heath, since the conversation started with you and you're former chairman of the CFTC, Commodity Futures Trading Commission, we'll start with you. Thanks.
How did I get to crypto? Wow, that's a great question. And I would say, like, for me, it was about the same time that I was working with the congressman on CFIUS issues, thinking about national security, thinking about the future of the U.S.-China relationship. And during that period, I worked at something called the Financial Stability Board, or I was the U.S. representative. So it meets in Basel, comes up with financial regulations. And something remarkable had occurred there that at the time, Carney, President Carney of the UK Bank of England, said there's this thing going around with Facebook where they're going to create a new global currency that will overtake everyone's currencies around the world, and you need to know about it. That was basically my first introduction to crypto, and the idea of having money that went over the internet on public blockchains. I had heard of Bitcoin, but at that point it was sort of a fad. But it was then when I realized that this is going to be big.
Yeah. G, how about you?
Yeah, mine is, first of all, it's great to be here. Thank you for having me. Mine's a little bit more personal. I had a friend of mine who I would run into him at different social events, and each time I saw him, he would say, this time next year, you could buy your beer or your drink with Bitcoin. And I thought he was absolutely crazy. But due to his incessant nagging, I started to read Satoshi Nakamoto's Bitcoin white paper and fell in love with the concept of Bitcoin and cryptocurrencies. By way of background, I actually used to be a corporate bankruptcy or restructuring attorney, and I fell into the area of law because I wanted to apply my legal skill set to help distressed companies with failing financial health to restructure, improve their operations for the betterment of their employees, customers, shareholders, and suppliers. And that is actually another reason why I jumped into crypto. I believe personally that crypto has an opportunity to transform and improve our legacy financial systems, payment infrastructures in a way that improves the lives of so many, to give people who don't have access to the traditional financial system in a positive way, which led me to work for 2 global cryptocurrency exchanges and custodians. And now in my role at CCI, which is a global educational advocacy organization, we represent our members and partner constructively with regulators and policymakers around the world to help shape credible regulatory frameworks to help this innovation grow in a responsible manner.
So CCI, Crypto Council for Innovation.
Exactly.
And Brian, So you were at the CFTC also, I think the same time that,
Yes, I had the pleasure of being a commissioner when Heath was our 14th chairman. I started off at the CFTC in 2017 under the prior chairman, Chris Giancarlo. I had been nominated originally in 2016 and was renominated in 2017. So I had a long confirmation process, but I had an even longer path to that nomination. And during that entire time period, I wasn't really thinking about crypto. I was thinking about Dodd-Frank and how the rules had been written in response to the global financial crisis, and ensuring that if I had the chance, I could help to recalibrate those rules from what I saw was a draconian approach to the financial markets through an overreaching piece of legislation. But 3 months after I joined the CFTC as a commissioner, one of the exchanges over which the CFTC had authority certified a Bitcoin futures contract. And I think there are two kind of things there. The first is that the CFTC has a wonderful process in statute that is very pro-innovation, that reverses the burden of approving new products. So instead of putting the regulator in the position of approving something, it puts the regulator in the position of having to object to something that an exchange has already said meets the requirements of the act. And that's an important thing. In my view, innovation and regulators don't go very well together. And the proof of that outcome is actually in the marketplace and how many new and innovative products were listed in the derivatives markets since that authority came in line. And Bitcoin futures was a part of that process. And I think that's an important thing because I'm not sure that our agency, as it was constructed, or any agency, would have felt like they had the political protection or were risk-taking enough to do that. But we found ourselves in the position of approving the first crypto derivative listed in a regulated environment in the world, and it thrust the agency in the middle of the governmental debate on crypto and into the crypto ecosystem itself. And I was proud to lead, I think, a number of conversations with external policymakers and industry experts at the CFTC through my time there, exploring issues of cryptocurrency, including consensus mechanisms, stable coins, and other innovations.
thank you. Yeah, I hear a lot of times, it's unregulated market, Wild West and all that, but for those outside the United States, it's kind of two primary regulators, the SEC and the CFTC, regulating digital assets, but also the banking regulators, and Federal Reserve, and multiple regulators, banking regulators. But Brian, you and I have been up here before. We were in London a few months ago with the Parliamentarian Forum. That was great, and you have a good way of explaining sort of what is this stuff we're looking at? What are digital assets, cryptocurrency, whatever you want to call it? And there's different things. I know, today I think there's some 23,000 cryptocurrencies, starting with Bitcoin and others, but that's quite a lot.
Yeah, so let me maybe just start by what I think this innovation means, as opposed to what it is or how it operates. I think everyone should be able to have access to plenty of educational materials to figure out the mechanics of it. But as I kind of look at the innovation of crypto, tokens, digital assets, pick your own monitor. The thing that Bitcoin did was it created the ability to have a unique digital item, right? In the past, anything that was digital could be copied infinitely and traded without the ability to know whether or not it had been double spent. So the creation of the Bitcoin blockchain and the Bitcoin consensus mechanism allowed something to be digitally unique. That in and of itself was very powerful. And then it also allowed that digital unique item to be transferred from individual to individual in a trustless fashion. So you did not need a trusted intermediary to transfer that value or that product. That created the ability for that process and that token or representation to have value. Right? And I don't know what that value is. I don't know if it's small, I don't know if it's large, but there's a marketplace for it, and the market's going to decide what that value is. The Ethereum blockchain comes along and it adds composability to that. So instead of just Bitcoin representing something that is scarce, now you have a blockchain upon which anyone can build. They can build new products all of which can be decentralized, meaning no one can kick someone else off, no one can reverse transactions, and the code is public and immutable and open source, right? And so the way I think about that is that, Bitcoin is like holding a dollar bill, and the Ethereum blockchain is like holding an iPhone, right? One is a world computer, and the other is, the trust that you have in it to be able to redeem it for something. The way we think about that innovation at A16Z, at Andreessen Horowitz, is that it's going to create the next evolution of the internet, right? When the internet started, we can call it Web 1. Web 1 was an open source internet. It was an internet of protocols, of open source protocols, HTTP, SMTP, right? Anyone could build on it, and you knew that if you built something on it, you owned it. But it was a read-only internet. You took things from the physical world, you put them online, you engaged with them on a one-on-one basis. Web 2 comes along, and it's an internet of networks, right? It's a read-write internet. It's an internet of community, of engagement, of content. But it becomes a closed internet, dominated by 3, 4, 5 tech companies that control all of the intellectual property and all the value associated with it. We think Web 3 is going to return to the open source nature of Web 1 through public transparent blockchains, but through tokenization, allow the internet to become a read, write, own internet, where individuals can own the value of their intellectual property, own their digital identity, and own the value of their contribution to networks.
I thought, G, maybe I'll turn to you just to elaborate on that a little bit. Brian mentioned the term blockchain. I'm not sure we discussed that enough, and maybe you can look at definition of that.
Thanks, JC. That was a great explanation by Brian. I've heard a lot of explanations, and that's definitely up there in terms of simplicity and easy to understand. The blockchain is sort of a lot of the underlying infrastructure which all of this is built off of. So the way I see it is that it is a secure ledger-based or database to allow for the recording of these transactions, the processing of these transactions. And when we think about digital assets and the blockchain technology, for me, I think of a lot of what are the potential possible use cases. I think in my line of work at CCI, a question that I often get asked is what is this for? Is this a speculative investment? Is it a fad? What is this being used for? So I want to highlight very briefly 2 use cases that I personally feel a strong conviction on. One is remittances, whether it's stable coins or cryptocurrencies. I'm from New York. That's my home city. In New York City, on an annual basis, New Yorkers send about $10 billion home to their respective families overseas in different countries. If you use traditional financial institutions for remittance purposes, the average transaction fee is anywhere from 5 to 10%. If you use cryptocurrencies or stable coins, it could be as low as 1% or even sub 1%. The transfer window to send remittance payments, to your home country or to your families overseas can be days when using traditional FIs, whereas with cryptocurrencies, that transfer window shrinks from days to mere seconds. So I think when we think about cryptocurrencies or digital assets, it's truly a borderless asset that we're talking about. And the fact that this could go back and forth in that seamless, efficient way is a very powerful use case, in my opinion. I read a statistic recently that by 2026, the remittance market would be about $1 trillion. When you keep that broader context in mind, the potential for cryptocurrencies to revolutionize the remittance market is very, very powerful. The second is non-fungible tokens, NFTs, which is sort of it's a way to secure authenticity on the blockchain. One specific use of NFT that I am very passionate about and believe a lot in is digital art. So I'm not very artistic myself, but art is subjective. But in the South Bronx, and Congressman Richie Torres had a great op-ed on this piece, the artists in his district are using NFTs to promote their art and creativity. But what's fascinating about this is that you could embed in the underlying infrastructure a stream of royalty payments, so that if I were to sell a piece of art to Heath, he would purchase it, and if he sold it to Brian, my family would keep on getting that stream of income payments, which allows the South Bronx, which is a very impoverished, poor district, the people there to keep on increasing their wealth by virtue of the NFT and the blockchain technology.
Thank you. So would somebody sending that money to whatever country outside of the United States, from New York to wherever, would they worry about fluctuation of the currency?
Sorry, I didn't catch the second half of that, JC.
Would they worry about the fluctuation, the value going up? People invest in Bitcoin, and they've seen significant increases and then significant decreases in that. So is that, we mentioned the remittance is one use case. And I guess if you change it back into fiat currency right away, that's not an issue, but, and I
Yeah.
kind of want to lead into my next question with Heath.
Well, I'm happy to respond quickly and turn it over to Heath. I think, like all young asset classes or younger asset classes, cryptocurrencies do have a sense of volatility. The prices do go up and down. That said, Bitcoin in particular is seen as a hedge against inflation, a sort of value. And when we talk about remittances, and Heath, I'm sure is well suited to speak on this, stablecoins have a particular, use case or important role there. And stablecoins are pegged one-to-one to an underlying fiat currency like the dollar. So there is no inflation back and forth volatility concern that you would have with other cryptocurrencies like a Bitcoin or other digital assets.
Yeah, so there's different, people talk about cryptocurrency. It's not one cryptocurrency. It's different kind of cryptocurrency, one being a payment stable coin. And that's what I wanted to turn to Heath about, and maybe you could elaborate on that.
Sure. Thank you so much. And I guess going back to the analogy too, some of the analogies that people were throwing around, because some of this stuff, now this looks like a pretty sophisticated audience in terms of crypto. Many of you raised your hands as having cryptocurrency. But for others, this may be somewhat new. How do you think about it? Because there's a lot of advanced computer technology here. One way I've thought about, well, what's the difference between the current financial system, which some people would argue, well, it is digital in many ways, right? We have a lot of technology. We are sending money by our phone. It's not necessarily cryptocurrency, but it's a series of closed networks. When email came out 30 some years ago, and for those of you that had email accounts back in the early 90s, you may remember that you could only send an email to someone else who had the same email account company that you did. So if you had AOL or whatever, you could only send emails to those people. Over time, given public internet protocols, now you can send an email to anyone in the world at any email address. That's not the case with money. It's a bunch of closed systems still. And what this technology allows to happen is for us to basically send money now all over the world over the internet itself, as opposed to these proprietary closed systems, many of which are very big. Many of the bank markets are very big, but you have to be a bank to be a member, and ultimately there's banks in between doing debits and credits. This allows you to send the value just like you're sending an email. So that's a big difference conceptually. That's kind of the way that I think about it. So what are the different kinds of cryptocurrencies, so to speak? Well, I think you did a great job, G, talking about different ones. You've got things that are speculative investments. Let's be honest here. There's a lot of volatility in something like Bitcoin. You probably aren't going to buy a cup of coffee with it, right, anytime soon, just like you wouldn't buy a cup of coffee with Microsoft stock. And NFTs, which are unique assets, artwork, stuff like that. But what's sort of the future of money? That's what the panel's called. Well, it's as simple as actually taking currency that we have today, fiat currency, and tokenizing it. So it performs the same way that basically an email does. And that's what stable coins attempt effectively to do. They take, in our case, Circle takes dollars. You come to Circle with $1, we give you a digital dollar. We take that dollar that you gave us and we invest it in very highly liquid, safe assets, US Treasury bonds, and cash in bank. You can then use that dollar anywhere you want, and when you ultimately come back, we give you the original dollar back. We obviously do this from a wholesale standpoint, not a retail standpoint, but the result is that we have $25 billion that are circulating in every single one of your countries right now, and people are using them as money, real money. And so stable coins in many ways are sort of the future, the first step towards a total digital currency. But the key there is that they're not volatile. So when you do the remittance that you mentioned, you can actually send money from here to Romania, for example, or to the Philippines or anywhere else, and they get the same dollars that you sent. There's no middleman. It just goes right over the internet, just like you're not charged for an email. So that's revolutionary, and I think we're going to see that expand over time. It also gives rise to a number of legal policy issues that legislatures are going to need to think about, but perhaps we can talk about them a little later in the panel.
Just so I understand, I mean, you mentioned the tether kind of to the U.S. dollar or relationship, but it could be anything of a, sort of a stable value, right? So other currencies or a basket of currency or precious metals.
That's exactly right. So it's a stable coin. There's a payment stable coin, which I think is much more specific, which is basically you're going to use it to buy and sell stuff. You're not going to use it as an investment. Other stable coins, you might say, well, I want a coin that represents gold. I'm not necessarily going to buy stuff with gold, but I'd like to have something that represents gold. But you can have a stable coin that's pegged to the value of literally anything, including a basket. The most obvious use case is fiat currencies like the dollar, like the euro, for example, but you're absolutely right, JC. A stable coin could be based on anything.
So it sounds like international remittance is one really important use case. It's going to be easier, faster, cheaper for people to move around their money, give money to their family, et cetera. Brian, may I come back to you? Maybe other use cases of this blockchain technology.
Yeah, so I mean, I think the key is to focus on when I said before about the progress from Bitcoin to Ethereum and to other blockchains that are decentralized. That decentralized concept is very important, and we can everyone can have different metrics around when decentralization is achieved, but the fundamental principles are fairly rigid, which is the inability to reverse transactions, the inability to kick people off, right, or permission access, and the immutability and open source public transparency of the underlying code. And that's important because that's what's going to drive, we think, that internet of value where contributors, individuals can own what they are delivering to networks. And you can see that in social media. I was just pulling up an app on my phone called Warpcast. Warpcast is now live. It's built on the Farcaster protocol, where your handle and all of your posts are stored directly on a blockchain. And Warpcast is one app out of many that can pull from that and present it in an interface that looks exactly like Twitter or X. And if you don't like the rules of Warpcast, you can go to a different app, and all of your posts will be there under your same handle, which gives you the ability to own your content and own your network. We can think about this in 5G network provision. There are huge capital costs to creating 5G infrastructure. There are zoning requirements. But through individual self-custodied wallets and a tokenized blockchain, we can now allow individuals to deploy a $2,000 device in their home that creates about a mile radius zone of 5G network provision that as large telecom firms offload their excess data, offload their excess 5G data onto that, what's called a Helium network, the individual that owns that device receives mobile tokens for that use. And that way you can distribute and disintermediate the need to have very large centralized 5G network providers. Xi already talked about music, right? The ability for musicians to sell directly to their fan base without an intermediary. There are over 15 million artists on Spotify. Only 40,000 of them, no, only 15,000 of them make over $40,000 or more, right? The average the take rate on Spotify is somewhere between 80 and 90%. And in the traditional music space, it's not a whole lot different. I think you have to stream a song 3 million times to make $1,000. Whereas, there are a number of smaller artists that are getting started that have a dedicated fan base that are willing to pay $100 or more for NFT number one of a song, right? Now you create a tighter knit community of that artist's fan base. You reward the artist more directly for their content, and you disintermediate rent seekers. So we think the application of the technology is profound, and we think it can apply to all sectors of the economy. And these are live use cases. So I think I would personally retitle the panel The Future of Value, even though I think the future of money is an incredibly important part of it.
No, that was great. How about, talking a lot of the benefits, what are the sort of the risks or downside of using a cryptocurrency or a stable coin? Are there privacy concerns, or we hear about illicit finance? I think we're going to talk more about that tomorrow, but we can touch on that as well.
Well, maybe I'll take the stable coin. So again, a stable coin is basically stable value. It's linked to a fiat currency. And this one's real simple, folks, in terms of foreign policy. Not all stable coins are stable, and not all stable coins are equal. And so you have a major amount of variation in these stable coins. And again, they're in every one of your countries. In some cases, there's literally billions of dollars or euros sloshing around. And if they're issued by someone who is unregulated, who doesn't actually have any assets backed by it, there are some stable coins called algorithmic stable coins, which are fascinating. They are fascinating. If you're holding it and the value plummets, it's not too fascinating. But basically, they're not really backed by anything except mathematical formulas. And so you've got to be really careful in terms of policy and saying, if they're going to use it for payments, if it's going to become part, almost side by side, your national currency, what's backing that stuff? So my firm, for example, Circle, is regulated in all 50 states. We have a money transmitter license from the US federal government, and you can go to our website at any time and basically see everything that's backing up our reserve. So if we have 25 billion issued, you'll see we've got X amount in cash, we've got this amount in a money market fund that's run by BlackRock, and here are all the CUSIP numbers for our treasuries, literally the treasury bonds backing this stuff. One of our competitors, well, many of our competitors that are based overseas in opaque jurisdictions, we have no idea what's backing those dollars. And so that's a major public policy concern because it can lead to consumer protection risk, financial stability risk, and other things as well. Another risk is obviously hits close to this group home is anti-terrorism, money finance, counter-terrorist finance. Many of these dollars they're being funneled to Hamas, to other groups, and there's no AML CTF. So again, a firm like ours, our customers have to go through the same screening that the banks screen their customers on, but a lot of these people in different jurisdictions don't. So there are a number of risks that come with this, despite the great, I think, technological benefits and the fact that I think it's going to be much better for users in the end. We've got to have our eyes wide open to the risk.
If I could just chime in here real quick, I think Heath brought up a great point, which is the regulated versus unregulated, status. With Circle, obviously, Heath walked through all of their different licenses and regulatory status across the world. Your question, JC, was about what are the risks and concerns with this asset class, with cryptocurrencies. What I want to highlight is, like any young asset class, what is really important for this asset class to grow and innovate in a responsible manner is legislative clarity or regulatory clarity around the world. When he talked about the MTL licenses, that does exist here in the US at the state level. Obviously, as some of you in this room may know, at the federal level in the US, there is a lack of clarity as to which regulator will oversee these markets, the SEC or the CFTC, and then we'll get into that in a little bit more detail later on. But when we talk about the concerns or considerations of cryptocurrencies or digital assets, it's that we want the jurisdictions across the world, all of your respective countries, to provide clarity for our industry. And the reason why I say that is our industry actually wants clarity. In a way, we have less thoughts or concerns about, do the rules have to be perfect for purposes of crypto? It's just that we want the clarity. So if you look around the world, Singapore with the MAS, they provided clarity for stablecoins as to what they're going to audit, examine, the underlying reserves, the types of assets that you can have underlying the peg of the stablecoin. Same thing with Japan. Same thing with the EU and MiCA. So when we talk about all these global jurisdictions, what I'm seeing and what I like to refer to this is a race to the top. In the next 1 to 2 years, we will see different jurisdictions around the world providing that clarity, providing that credible regulatory framework so that inventors, innovators, entrepreneurs, builders, stablecoin issuers can build their products in their home jurisdictions in a way that provides a clarity for both the market, consumers, as well as the government. And I think while that is a concern, I'm hopeful for the future because from what I'm seeing in my line of work at CCI, a lot of policymakers and regulators around the world, including outside the US, are way ahead of that, so which I think is a very positive sign.
And if I may add just one more point onto that, we definitely need clarity and strong, sound regulation. But one of the things we've learned in the last 2 decades since 9/11 with AML CTF standards is if they're inconsistent, that's going to cause a ton of problems. And we've learned this in other areas of financial regulation. I see a number of people here from the European Union, for example, and the European Union has really been a leader in coming up with regimes that have recognition, substituted compliance, where basically there's a race to the top where everyone comes up with similar regimes, and then there's recognition of various countries' regimes because they're largely the same. At the very least, they have the same objectives and goals, and I think we really want that so we don't have regulatory fragmentation, because that will also, in many ways, destroy a lot of the value that this technology brings.
Yeah, let's talk about that a little bit more. I mean, regulation and legislation policy, and we're with a group of parliamentarians who care about policy and legislation, and every country's different. In the U.S., there's a lot of laws in the books, legacy laws, that you can apply to the digital realm. And then we find that there's, beyond that, maybe there is a need for new laws. So in the U.S. Congress, and I think we talked about it a year ago when we were sitting here, for those who were here, met with Senator Lummis and others, there's several bills in the U.S. Congress, and I think the House Financial Services Committee has been probably the most active with 2 bills, one on stable coins and basically providing the authority of the Federal Reserve to write rules and regulations around stable coins. Some other pieces of that, and then another bill on crypto that better defines whether a token is a commodity or a security, and a lot of other pieces of that. We don't need to go all the legislation now, but is there, as you look around the world, are there certain jurisdictions that are more advanced, I guess, with providing a framework for digital assets than others? And maybe let's start with you, Brian.
Yeah, thank you. So in the entire history of Andreessen Horowitz, we've only had offices in the United States, and we just made the decision this June to open our first ever international office in the UK to embrace the approach that they are taking towards crypto regulation. We're not going there, and we're not encouraging any of our portfolio companies to consider moving there to escape regulation, but rather the opposite, to actually embrace thoughtful, well-calibrated, proportionate regulation. And the reason I say that is because it's a regime that understands that legacy financial product rules don't necessarily fit the technology, right? And I'll give you an example of that. If the securities laws exist to protect investors from insiders, to protect investors from insider information, right? The misuse of a management team over the resources or the funds that have been invested in them. If there is an issuer of a financial instrument, right, like an equity or a stock, right, then that issuer in the United States and in UK and other jurisdictions has to submit disclosures so that investors know what's going on with the company. They have to submit things like a balance sheet and an income statement, sometimes a cash flow statement and other risk disclosures. If you viewed, public decentralized blockchains that have, built-in constructed reward mechanisms for issuing tokens for people that participate in them as a security issuer, and that means someone somewhere would be responsible for reporting what Bitcoin or Ethereum or some other blockchain's balance sheet is, or what its income statement is. I'm not sure what that would mean, and I'm not sure who would do it. They'd also, under US law, have to do things like mail out proxy statements to all token holders. Right? I don't know how that's possible. So old rules don't fit the technology. It doesn't mean that new rules aren't needed, but they have to be thoughtful, they have to be well calibrated. They also have to not enshrine centralized concepts in them, otherwise you defeat decentralization, which for us is the entire purpose of the technology. If you require a token issuer to have ongoing disclosure requirements, to be registered, to continue to report information, you're going to preclude that token issuer from ever decentralizing itself. You might as well just kill the technology. And maybe that might be some people's goal. It might be some people's goal here in the United States. But the UK is getting that right. And in a matter of months, we think the UK could be light years ahead of the United States. So we're very focused on that jurisdiction, and we've had a lot of positive conversations with all political parties across both chambers of parliament, and are very hopeful for a positive outcome in the near future.
Thank you. And, outside of the UK and the US, SG and Heath, are there other jurisdictions that, offer a template of how to regulate the space in a balanced and thoughtful way?
Yeah, before I answer that, I would agree with what Brian just shared, just to piggyback off of that very briefly. That's been my experience with the UK as well, certainly CCIs. And the UK government is taking a very modular, pragmatic approach to crypto asset regulation. I was speaking with one of my colleagues in London, and she described it as a cradle-to-grave rulemaking. And I thought that was a fantastic phrase. And that means that the regulators and policymakers, they are doing this in a piecemeal fashion, intentionally, to engage with industry, and I think public-private partnership is so critically important. And just this past summer, CCI met with the HMT, the UK Treasury, to talk about various crypto asset issues and what the right rules and regulations could look like, sharing our perspective. So I think the UK is very forward-leaning. I think the future there is very bright. In terms of other jurisdictions, as I mentioned, I don't see a silver bullet anywhere. I think each jurisdiction is going to come up with the rules and regulations that best conform to their market, their existing rules, and of course their customer investor base. But I think one common theme that I've seen is, again, as I mentioned, they're first movers. They're looking to provide the clarity. So with the EU, they have MiCA. In the US, we're sort of getting bogged down with the securities versus commodities issues. And as Brian mentioned, a lot of digital assets are commodities, in my opinion. And the reason why commodities and securities are regulated differently in our country, and of course Heath and Brian can speak much more about this than I can, is for most cryptocurrencies, there is no information asymmetry. If I were to purchase a share in the McDonald's stock, the McDonald's centralized management team owes me information for me to make my investment decision whether or not to invest in a share of McDonald's. Financial information, their profits, their revenues, their management decisions, but you don't see that with digital assets. There's no CEO of Bitcoin or CEO of Ethereum. So for me, a lot of cryptocurrencies are commodities and should be regulated by the CFTC. When it comes to the EU and the MiCA, they did not focus on, is it a securities or commodities? Do we shoehorn it to the traditional rules and regulations? What they instead did was come up with a comprehensive framework capturing as many different actors in the cryptocurrency space as possible. Asset issuers, stablecoin issuers, service providers, the tokens themselves. So it's a much more comprehensive framework over in the EU. I'm not going to say it's perfect. That's my personal opinion. We'll now see the 27 EU member states looking to implement them as a next phase, and that might have some hiccups. But I think the fact that the EU has that, we're seeing even a lot of US companies not necessarily leaving the US, but opening up their offices and building over in the EU because they at least know what they can work with, which I think is very important for our industry.
Not too much to add on that account. Obviously, the EU was a first mover in this area in many ways. The UK is some very promising sort of proposals that have come out that they're working to finalize based on their recent legislation. And then I'd also say Asia, Singapore, Japan, a lot of countries are moving forward. The UAE, for example, has just come out with, at least on stable coins, sort of a proposed regime. So everyone is moving forward here. I think it's a tough one because you want to make sure it's great, but I wouldn't let the best be the enemy of the good, because clarity at this point I think is better than no clarity, and they can always be tweaked over time. But I do think it's important, just for consumer protection of reasons alone, quite frankly, to have some legislation in place. As far as the US goes, just maybe going back to there, everyone in this room is probably familiar with Winston Churchill's famous quote that Americans will always do the right thing after they've exhausted the alternatives. And in some ways, you come here to the United States to, for us to share with you what we're doing on this, that, and the other. This is one area where, quite frankly, we can learn from a lot of your jurisdictions what you've been doing. But the United States will, it's not a question of if, I think it's a question of when. We will pass legislation because it is needed in certain areas. My guess is that payment stable coins comes first because it's simple, it's less complex. A lot of the issues about security versus a commodity are not at issue there. But ultimately, we do need a market structure bill as well. And there's some very good models that have been proposed. So that may be a thing for future forums. But right now, I would say, unlike other areas like counterterrorist financing, AML, CFIUS, this is one area where the United States, quite frankly, is behind.
Yeah. So the risk, I think I'm here of over-regulating, so that may be driving innovation overseas or other jurisdictions. And but there's also, if you can't beat them, join them. So you also see governments now pursuing their own digital currencies, what we call a CBDC, or central bank digital currency. So now there's, I mentioned earlier, some thousands of different private digital currencies. The government say, we'll get a piece of this too. And so almost every country, at least the developed world, is looking at a digital currency, a CBDC. The US is looking at it. I think I heard where Italy and South Korea just put together an MOU. They're going to collaborate on a CBDC. So lots happening around the world. I don't know, let's jump in first and give some thoughts on a CBDC. And is that something that, given it's it comes from a central bank, does that crowd out a private digital currency, or are there other benefits or risks to a CBDC? How about you, Heath?
So interestingly enough, the question becomes, of course, you're talking about tokenized dollars, digital dollars. Well, why not the Fed? Why doesn't it put out digital dollars, right? So CBDCs, really, really fascinating subject. What I would say is there are both promise and peril there. First of all, I think it's a good sign that central banks around the world want to advance it technologically. I don't think any of us wants our central bank to be, Luddite in form and sort of, existing based on technology that's 30, 40 years old. But at the same time, I would say it raises a lot of profound public policy concerns that we've never had to confront before. Case in point, China. Another case in point, Russia. Both of them realize that being able to issue your own currency, where you can track the behavior of every single citizen, is a powerful surveillance tool. It's a powerful tool to be able to run your society and make sure that it's consistent with the party. It's a powerful way to infiltrate other countries, to bring your currency into Africa and other places like that, create dependencies, all from a single central bank in Beijing, for example, right? And so a lot of Americans look at this, as well as others in Western democracy, and say, hey, wait a minute here. I don't think I like this. I don't like the idea of having every single transaction be potentially subject to government surveillance, because once it's there, once the government has issued these coins, it's there in their computer system. They can track everything. So people obviously are aware of that. I think there's a question of, can we have two types of tokenized dollars or euros or whatever the currency is, one that's maybe a wholesale model issued by central banks, and one that's a retail model where, for example, private stablecoin issuers, where their coins are backed by the central bank coin, are issuing out into the public. The other big issue is an economic issue. If everybody effectively has an account at your central bank, what does that mean for your banking system? Private banks are very concerned, as you mentioned, that there's going to be a crowding out effect. So that's another economic effect of all of this, putting aside the civil liberties, the surveillance, and everything else. So that's just a little sprinkling of the kinds of issues that are arising with the CBDC debate, which is fascinating.
Jeet?
Yeah, I think Heath mentioned a very serious concern, which is privacy. Another concern or consideration that I have is interoperability, the coexistence of all of these private and public forms of money. I hope I'm not saying anything controversial up on this panel, but I think the reality is that we will most likely, as the world becomes more digital, see a world with multiple forms of digital money, public and private, whether it's cryptocurrencies, stable coins, as well as CBDCs in certain jurisdictions. The Atlantic Council came out with a study about a few months ago where 130 countries are actually either exploring or have developed CBDCs in their respective jurisdictions. So it's inevitable that this is happening. But if you think about the coexistence, it's extremely critical that any jurisdiction who is exploring or pursuing CBDCs, They do not do it at the expense of pushing out or banning cryptocurrencies or stablecoins. These can operate together, but like in China, for example, which is a good example, China has banned crypto trading and mining. They are developing their the digital yuan at the expense of other public and private forms of money. And there's serious privacy concerns there as well. But the coexistence is extremely key, because as the world becomes more digital, you want multiple options. Robust choice and competition in the marketplace is a very positive thing. And I think interoperability is one of my other big concerns as we think about CBDCs from various jurisdictions.
Brian, any thoughts on this?
I mean, just to, first of all, I'd like to echo Heath's comments that I think it is a wonderful thing that central banks around the world are thinking about how to advance themselves technologically. I think we need to give everyone credit for that. But I do think we all need to recognize that none of us are going to out-China China. And taking that kind of approach, or thinking that our government will be able to solve those issues or avoid the pitfalls of those issues, those are very significant policy discussions. Are going to take a long time to try to resolve. And even if there is some agreement on them, there is no guarantee that that is how they stay. I'm very worried about central bank digital currencies, not just if they can get it right the first time, but whether or not it can stay that way consistently. I think the reason that the West and the United States have the economies they do are because of entrepreneurs and innovation. And I think public, transparent, open source code upon which innovators can build, value can be transferred, trusted intermediaries like Circle and others can provide services. I think that's how we counteract the CBDC China threat.
I think that raises an interesting issue or question that, I've heard this before, where we can't out-China China, as you say, a very important point, but should we be more concerned or accelerate our own CBDC program? Because China may be out ahead of everybody else, and they're going to do it first. And is it a national security issue where not only they have their digital payment system centralized, but they're requiring other states and companies that do business with China to use that, and could replace the U.S. dollar or other currencies as kind of the main way of doing business? And so is that an issue, or is that even a reason for us to do anything differently?
I would say the reason we have achieved as much as we have in the United States and in your countries as well around the world is because we've used our democratic system and our free enterprise system together to harness the power of private enterprise and private endeavor. Again, two national goals. And that's the reason we won World War II. I think that's the reason we won the space race. And so there is something to be said here. Your point is a phenomenal one, which is, hey, wait a minute. If China and Russia are really interested in this stuff and they want to dominate the blockchains of the future, then it's probably pretty important. Maybe we should be doing something about it. And I think my view would be, rather than have the government step in and say, we'll take care of it, is to provide the legal clarity, the other sort of, the sound regulatory framework that's needed to allow these entrepreneurs and other market participants in our various countries to rise to the occasion. And ultimately, my view is that innovation and the work of a democratic free enterprise system will ultimately leap ahead of whatever technology the state decides that it wants to research and build.
Yeah, I would absolutely agree with what Heath just said. I think it's really important, especially for the United States on this topic, to provide that clarity, to keep the innovation, the expertise onshore. And I think what's extremely important is the public-private partnerships. I think more than the United States government developing its own CBDC, I think it's important for the United States government to recognize the transformative potential of digital assets, of blockchain technology, and work with the industry to study and develop that on a more direct basis. Like I mentioned, in my line of work, we have an industry, a lot of members who want to partner with the government in the U.S. to provide that clarity to build here in the United States. And it starts in the U.S., which is where we're behind. We provide the legislative clarity so that the market participants, the builders, the founders, the entrepreneurs know how to build and grow here in the United States. So I think that's very important for the U.S.
I just was quickly going to kind of expand the conversation beyond CBDCs just to networks generally. I mean, I think as I have spoken to people in the national security community, and I think as we heard a lot of former officials and current members of Congress today, you know, the internet and networks are a battlefield of the 21st century. And China wants to either control the internet or have unfettered access to distributing information, misinformation, its own propaganda over the internet. Instead of trying to, again, out-China China or compete to control the internet or networks, the most logical solution is adopting something that keeps networks open, right? That prevents individuals or countries or jurisdictions or entities from controlling that flow, from permissioning that access, right? From kicking people off, from reversing transactions, et cetera, which again, we believe has a fundamental alignment with public decentralized blockchains.
So that seems to be a real issue with the CBDC, whether it's in China or elsewhere, is sort of the privacy issue or surveillance capability. They can see every single transaction, how much, where it went to, and there's the social scoring issue. Would we ever do that? People say no, but you look toward north a couple years ago with, you had the truckers protest against certain COVID restrictions and mandates where the government cut off credit cards and so forth to the GoFundMe that were supporting the truckers in their what they thought was free speech or advocacy against the mandates. So it's not so far-fetched. This may be a good time, I don't know if we're provocative yet, but open it up to some questions from you all, if you have any questions. Yes. Do we have a microphone?
You want to just speak loudly and we can, yeah.
Yep.
So how to adapt these technologies, how to attract more, let's say, driven companies, how to use blockchain crypto technologies to the country, and how to benefit from this new, let's say, world which is creating now around us.
Does everybody hear that? So gentleman from Georgia, I love Atlanta, by the way. No, different Georgia. And yeah, how should smaller countries be looking at stablecoin, cryptocurrency by way of regulation or benefits? You want to take that, Brian?
Well, from the venture capital side, let me tell you about some of the reasons why, we chose the UK and how I think you can think about, Georgia in that context and where, you can decide what progress, they may need to make. I think as we're looking at a jurisdiction to try to locate or source for investment, first of all, I think at this point ideas are global, right? I think we have access to global ideas. We have access to, the best founders in the world, and if the smartest people that are trying to form companies with great ideas, I think I have a strong belief that they will get funded. But I think as we're looking at jurisdictions broadly, we're trying to look for three things. Number one is a deep pool of talent, which is usually exemplified by world-class universities and very technical expertise, in software and programming, et cetera. Number two is a regulatory environment that's conducive to entrepreneurialism and especially to innovation in this space. So, the appropriate kind of rules that don't enshrine centralization like I talked about around disclosure obligations, that force things into legacy systems that don't work, right? So a right-sized regulatory structure. And then the third is kind of a culture of entrepreneurialism where the best and the brightest want to go start a company. right? They want to take a risk. They want to go work for a startup. They don't necessarily think that the end all be all is to go work for the government or the biggest established firm, in their jurisdiction. So that there's kind of a culture of risk-taking, entrepreneurialism, and innovation. And so those are kind of our three key metrics, and judge them, as you see fit for your own jurisdiction. But if you know of good founders, send them our way.
Y'all want to add anything to that?
Yeah, just to quickly add, and I know I sound like a broken record, but I think, before I joined CCI, I worked for a global currency exchange and custodian, like I mentioned. A lot of what I did was talk to different governments in my role to determine how my company could partner with those governments to grow digital asset innovation and be intentional in partnering with the communities there to commit financially partnerships, help the schools that Brian mentioned, help the neighborhoods in those schools. So what I'm trying to say is I think you have a lot of companies in the digital asset industry who want to talk to various governments and better understand the culture, the market, what the customer base in that jurisdiction is looking for. Is it stable coins? Is it NFTs? Is it decentralized protocols? What does that market want? And I think it may seem like a very obvious point, but the more there is public-private partnership with this industry, I think even the smaller or the younger jurisdictions can really focus on being a front mover in terms of legislative clarity, regulatory clarity, but also understanding how to use this technology for the betterment, for their people.
Yeah, and maybe I'll just add that, prior to my last stint in government, one of the big projects that I worked on was advising central banks from various regions around the world deal with the challenge of dollar clearing in their countries. They had a situation where their local banks, were getting basically dropped by the big U.S. banks. They weren't being able to get access to dollars. And that remains a big issue. Well, one of the things that dollar stablecoins does is it alleviates that issue. So in Georgia, for example, is it the Lari? The currency, you can get a bank account in the local currency. It's harder to get one in dollars. It's harder to get one in euros even. And so by having stable coins, US dollar, again, they have to be backed, they have to be well regulated, that can serve as a way to alleviate the dollar clearing strains on your banking system and on your industry that want to interact with larger economies like the European Union or the US. So that's sort of another variation, but it's an older economic problem, but it's a way where I think blockchain technology can be helpful.
Any other questions? I see Dr. Una McDonald. Una spoke at our London forum and wrote a great book called Cryptocurrencies, Money, Trust, and Regulation, I think, if I have that right. Available on Amazon. So, Una.
Thank you very much for the advertisement. I wasn't quite expecting that. But I do have a couple of issues which I don't think have been addressed in the excellent and interesting presentations from each of the participants. The first one concerns decentralization, and one can make it sound very virtuous and laudable and so on. But there are two problems with centralization, and one is linked to the method of proof that's used. If it's proof of stake, then of course the larger stakeholders can wield influence more easily over the operations of the network. So that's one issue. The second issue with decentralization, looking at it from the consumer's point of view, so often we have complaints and difficulties with companies of various kinds. In a normally structured company, we know who to go after. We can look at the board, we can look at the chief executive, or maybe they even have a complaints officer in charge of complaints. And so you do know where to go, you know who to phone up, you know what the address is, and you know who to complain about when they don't deal with your complaint. None of that can apply if it's decentralized, if the governance is decentralized. That's not a new idea, and if you'll forgive me for a brief historical diversion to mutual building societies in the UK, which were mutually owned by all the individual participants and borrowers. What happened over time? They no longer were mutual, in that sense, run by the owners. Instead, of course, they acquired a head office and a chief executive and a chairman and a board. Why? Because it was necessary to do that as they grew and developed from the very small mutual organizations that they were originally. So decentralization and the lack of ability to hold individuals responsible for what is going on in that organization. The other comment I want to make is about the largest stable coin, dominates the market, which is, of course, Tether. Tether, despite being allegedly a stable coin, does actually fluctuate. And a number of days, I think I checked most of September, you would have lost 10%, between 5 and 10% on your holding. But that maybe is not the main issue with Tether, is where are the assets? And do we know which bank acts as their custodian? And do we have any confirmation that they actually have the assets to back the peg?
Okay, so I'm going to get 2 questions there, and we have 2 minutes, so I want to make sure we answer at least one of your questions. And
May I take the second first? It'll be 10 seconds.
Yep.
I was very careful not to name any names, but you just did, and I couldn't agree with you more. All stable coins are not equal. Some are stable and some are not, and that's why I think sound regulation is important, and at the very least, consumers should be looking out at what's the transparency, what's backing those assets, and of course, is there a company you can hold accountable that's in a jurisdiction that has laws and order?
Thank you, Dr. McDonald. It's nice to see you again. I didn't necessarily hear a question for your first 2 comments, but let me maybe react quickly if I can. On your first point around decentralization, consensus mechanisms, and staking specifically, obviously decentralization and the metrics to achieve it are dependent upon how decentralized the ownership is. So if the ownership is centralized, then decentralization does not apply. However, if you were going to try to do that with something like the Ethereum blockchain, it would cost you tens of billions of dollars, and you would therefore lose all of that money because you would eliminate the value of that blockchain in doing so. Very costly endeavor. Someone may decide that that's worth their time. But then I think you also have a lot of game theory that applies to those kinds of activities as well. And on your last point around holding somebody accountable, centralized concepts, I would point out that the Linux operating system is decentralized. It's open source, and it runs 85% of the world's smartphones, which has reduced the price of cell phones around the world to something like $10, and more people have cell phones, smartphones, than have access to running water. And I don't know that anyone is worried about going after someone associated with Linux if there's a problem with their smartphone.
Great
Thank you very much.
observation. I will say we have another crypto panel tomorrow morning. I would recommend you come to that crypto supervision and regulations. That'll be interesting too. But thank you very much for your time and interest today, and our panelists. Thank you. Great observations. We have another exciting panel coming on cybersecurity. Is that right?
Yes, sir.
Okay.
Very well.
Thank you.
Thank you all. Great panel.